In this presentation, we're going to focus in on investments using the equity method. In other words, we're going to have a situation where we have one company that's investing in another company. This time they have significant influence, and therefore we will be using the equity method to account for that investment. Get ready to account with Advanced Financial Accounting. In prior presentations, we gave an overview about different accounting methods that could be used based on different levels of influence and control. Those general rules being that if there is 20 or 0 to 20% ownership, we use the carried value, 20 to 50%, which is where we're going to focus in on now, the equity method. Idea there being that there is now significant influence. So in other words, if we own 0 to 20%, that would be kind of like you investing in a large company like Apple or whatnot, where the assumption being we don't have significant influence, even though we do have a vote of what happens. However, when our vote gets to be 20% of the total, that's kind of a shady line, or not completely a solid line, but that's kind of an arbitrary line that's been drawn. Then you're thinking, okay, now there's pretty much significant influence, and therefore we're going to use a different method, equity method, than if we're over 51%, which is a more solid line. If you have more than 51% and you're voting on things and you have like more than 51%, then you pretty much win. And that would mean control for that situation typically. And then we may use a different method, such as a consolidation. So we're going to be focusing in here on the middle method, where we have significant influence, where we have that lower line that's a little bit fuzzy, that 20% arbitrarily drawn. And then if you're over the 51%, then it's more likely that then you do have control and may be using the consolidated method in that case. So equity method, we're focusing in on investments using the equity method. The equity method will reflect the investor's changing interest in the investee. So we're going to try to basically reflect what's going on the investor side with the changing investment in the investee, the company that we are investing in, the company we have significant influence over. Investment is recorded at the starting purchase price. So we're going to start off basically in a similar situation as the carrying value. We're going to have the purchase price is what we're going to be putting on the books when we purchase the investment under the equity method. And I believe the rationale would be that it's still a market-driven transaction. So when we have the initial investment, we're going to still record it at that price, because if it's an arm's length transaction, it happened on the market, and if we're trying to value something, that's a good starting point typically to value something at, because there's an actual transaction that took place on the market at that point. Then the investment is adjusted each period for the investor's share of the investee's profit or losses and dividends that are declared by the investee. And this is where the major difference will be. You'll recall that if we don't have significant influence, then we may wait until we get the dividends to recognize. In other words, we're not going to recognize, if we don't have significant influence, the revenue when the investee receives the revenue. We would be waiting until we get the dividends to record dividend income. In this case, rather, the investment is adjusted each period for the investor's share in the investee's profits. So as the investee makes profits, we're going to say, hey, we have significant influence, idea there being that we could influence them to give us the money, possibly. Now, we don't have 51%. We can't force them to give us the dividends, but they would have to declare the dividends to give us the money. We have 20% interest or over, or that's going to be like kind of that line. So that's pretty significant influence that we may be able to get access to that money if we wanted to. And that might justify us recording the profit when the investee gets it, rather than basically waiting for the dividends. And dividends, okay, so the profits and or losses and the dividends that are declared by the investee. So in other words, we are going to record then the dividends. We're going to show the dividends. It's going to adjust our investment account, right? But we're not going to record income in this case on the equity method as we did under the prior method. If we don't have significant influence, we recorded dividend income when they gave us the dividends. This time, what we're going to say is when they give us the dividends, we're going to make an adjustment to our asset account, the investment account. We're going to record the income at the same point in time that the investee gets the income, and that's when we will record it. So we'll take a look at some more examples of that shortly. Investment using the equity method. Equity method is used for joint ventures, companies where the investor's voting stock interest provides the investor the ability to exercise significant influence over the operating and financing policies. So that's going to be the general rule that you want to have here. This is the main quote, the idea, the terminology that you want to have in place. the ability to exercise significant influence over operating and financing policies. So in other words, you're probably going to memorize more easily the general rule of 20% and over. That's what most people have in their head. But that's more of an arbitrary number. And what that number is trying to get at is to get some point that we can measure easily where this would take place, where there would be an ability to exercise significant influence. So you want to have both those in place. This is what we're aiming at with that 20% number, for one company to have the ability to exercise significant influence over the other. So significant influence, quotes, 20% rule. If there is not evidence to the contrary, an investor holding 20% or more of the investing voting stock is presumed to have the ability to exercise significant influence over the investee. So there's that 20% rule. So we're looking for significant influence. And if someone is 20% or more, and again, less than 51%, because 51% would be control, but if there's 20% or more and we're looking at that 20% line, then we're going to assume that there's going to be significant influence unless there's some reason not to. So if there is not evidence to the contrary, in other words, an investor holding 20% or more of the investing's voting stock is presumed to have the ability to exercise significant influence over the investee. When might that not be the case? You might say, well, we have 20%. It would presume, but I have evidence to the contrary. What would that evidence be? Possibly somebody else owns 51% of the stock and we have 20%. We can't significantly influence anything when someone else has a 51% voting share, right? So that would be the most obvious kind of exception to the general rule. Okay, so what would the journal entries look like? Let's look at this in terms of T accounts now. So we're going to say, if we're the company that are investing in ABC company, we're going to have an asset account that's going to be the investment account, investment in ABC. We're going to have an income account that's going to be income that's going to be related to ABC company. And then we'll have the cash account down here. So first we're going to invest in it. So we buy the stock, and this would be similar to if we didn't have significant influence, right? We're just going to record it at cost, just like we normally would for any type of investment. Again, this would be assumed to be a market transaction, and therefore cost is a good number to use if it were a market transaction. So we're going to debit the investment, the asset account, we'll credit, let's say, cash down here. Then let's say that there's income. Now we're going to say that there was income that was reported on ABC company's income statement at the end of the month, quarter, or year. When they get the income, then we're gonna automatically record that on our book. So we're gonna say they made income. In other words, this is where it differs. We're not waiting until they give us the dividend here. We're recording the income when they earned it. So that would be an increase to the investment. So whatever we started at, the cost at market value plus the income that we got, the other side then going to our income account, our income statement. So our income statement is going up related to our portion. So if we own 21% or whatever of this other company, we'd say 21% basically of their bottom line net income there. Now, if there was a loss, this is an either or situation, right? If there were a loss, then of course, we would represent our portion of their loss. Same concept here. That time decreasing with a credit, we would be decreasing our investment. In other words, the investment would be on the books at cost. Then we would be decreasing it for the loss, basically on their income statement, our portion, our 21% or whatever we own of their loss, we would be representing as a credit, decreasing our investment. And then the other side going to the income statement as a debit, which would represent a loss. In this case, a negative income, right? It's a loss on the income statement. And then we're going to say, well, what happens when they have dividends? In the case of dividends, if the company that we're investing in, we're a company that invested in ABC company, they're going to give us dividends, which we're going to assume be cash. Now, when they declared it, it would be dividends receivable, but let's just say we're going to get the cash for the dividends, right? So cash is going to be going up. We got cash. Now, if we did not have significant influence, if we were not using the equity method, then we wouldn't have recorded the gain or loss here. We would be recording the dividends as basically dividend income. So we would have gotten cash under that method and then recorded basically income up top as dividend income. Here, though, we recorded the income when we got the money, right? When the investee earned the money, not when we got the money. So note that the relationship here is between the dividends and, let's say, the income, right? If we're talking about this company, we've got the dividends that they give out and the income. If we don't have significant influence, when ABC makes the money, we can't really force them in any way or influence them significantly to give us the money. And therefore, we're more of a passive investor is kind of the idea of this if we're under 20%. Therefore, that's when we don't, if that were the case, if we weren't a 20% owner, we wouldn't recognize income at that point, but rather wait until the dividends were given to us and then represent the income, because that's when we actually have it in our hands. That's when it is ours for sure. In this case, if we have significant influence, when the ABC company that we're investing in earns revenue, now we have significant influence to force them to give that money to us if we so choose. They don't have to, because the fact that they made income doesn't mean they're going to give dividends out related to the full amount of earnings that they made. They might just keep the money in the company and try to generate more revenue with it, and that'd be fine. But we don't have significant influence over that decision if we don't have a significant voting power over the company. So if we have over 20%, we're going to say, hey, if we wanted to, we don't necessarily make them give us a dividend, but if we possibly could with our influence we have, and therefore it would make more sense for us to recognize the income at the point in time that ABC makes it. In other words, represent our 20% of the income at the point in time they earn it. If we do that, then we've increased our investment by the income that they have earned, our 20% of their income. Well, what happens when they give us the dividend then? Well, we have already basically recognized the income up here, but of which you would think that the dividend came from. In other words, if ABC company made income, then the decision to give dividends, you would think, might be a result of part of the income that they earned, or at least for the lifetime of the earnings, right? So the dividends, you would think we'd have to net these two out. So if I record the income up here, then when they give me the dividend, I'm in essence netting that out against the income that I have recorded. In other words, I'm not going to record the dividend income again over here on the income statement. I'm just simply going to reduce the amount of the investment. I increased the investment here by the total income. I recorded the total income on the income statement. Then when they give me the dividend, I'm going to reduce the amount of the investment, and I'm not going to record it in income because presumably the income has already gone up by the amount of the income that was generated by the company, right? Which is usually greater than the dividend. The dividend is usually only going to be a portion of the income that was created by the company, generally speaking. So that's going to be the process here in terms of T accounts. Now, what are the pros and cons? Based on economic activity instead of dividend policy. So that's one of the better things here is that when you use an equity method, you're not, if you're recording things based on when the other company gives a dividend, then really you can kind of manipulate the system, because when they record dividends might not make a lot of sense. If you're actually recording on an equity method, you're recording your investment based on what's economically happening. So it's kind of the difference between a cash method and an accrual method, in that an accrual method is typically more thought to be more representative of the actual what's actually happening. And here, the economic method of an equity method is typically better in that sense as well. It's also fairly simple. It's like a one-line kind of consolidation. So it's similar to basically having one line item, that shows basically the consolidation process. In other words, we're showing our whatever percent interest in kind of like one line item and recording the increases and decreases in the actual earnings on like that one line item on our balance sheet for the investment that we own. Cons, continual adjustments are needed. So one of the negative sides here is you got to adjust it continually. So that can be, a little bit more difficult if you don't have significant influence and you're just recording dividend income in essence. Just the dividend income's might be actually a little bit easier to do than the equity method, but you still have to record the market. I mean, if you're adjusting to market value, so you still need a periodic adjustment in either case. And that might be something, again, done at the end of the period, something that's kind of like an adjusting journal entry type of process. So let's take a look at the journal entries. This is just a general couple journal entries related to the equity method. So when we purchase ABC company, so we're a company, we purchased investments in the stock of another company, we're going to say ABC company. So we're going to debit then an investment in ABC company. So we bought some stock in ABC, and we're going to say that puts us over the 20% influence method, and we're going to record it as a debit to the investment and a credit to cash. This is the same whether we have influence or not. This is a market transaction. So the idea there being that to record it at the market price, whether we have significant influence or not, is a good way to record that initial transaction given it's a market transaction. Then we have the recognition of income, usually a year-end adjusting entry. So at the end of the year, typically, we're going to have the recognition of income. So whatever income was reported on ABC Company's books, we're gonna take our portion of it. If it's 20%, if it's 30%, or whatever, if we own 30% of ABC, we're gonna say whatever they made, times 30% is our portion, and we're gonna record a debit to the investment in ABC Company. So it went on the books at the market price, whatever we paid for it, but we're increasing it by the financial statements of ABC, our portion, our 30% in this case, of what ABC earned. The other side is going to the income statement for ABC Company, our income statement. We're going to record it as income from ABC Company on our income statement, increasing income. And then what happens when they have dividends? So record dividends from ABC Company. So then we're going to have the dividends receivable, or you could think of it as cash. If we haven't gotten, when they declare the dividends, we'll have dividends receivable. If we wait till we get the cash, we would debit cash, right? So dividends receivable. And then we're going to be crediting not dividend income, because again, we already recorded the income up here. So notice up here, like if you were thinking about this process, you would think generally a company generates income. If they make 100,000 of income, then they might decide, hey, we should give dividends out for part of that. And the dividends are probably going to be thought about, they're probably going to be less than the income they generated. So if they made 100,000 of income, you would think that the dividends they give out usually will be less. It could be more because they could be taking it out of retained earnings. But usually the concept here would be, okay, if they made 100,000 of income, they might give out some dividends related to that, maybe 80,000 of dividends. We already recognize the income up here of our portion, the 30% of the 100,000. Our portion, the 30% of the dividends, then down here shouldn't be credited to income again. It's actually going to reduce the investment because we increased the investment by the full amount of the earnings, and so we need to bring it back down by the amount of the dividends, because we're going to get the dividends in cash. It's in a receivable now, then we're going to basically get cash. So now we're going to get the cash, and in essence what's happening is it's coming out of, we're going to say we cashed in part of our investment. It has now been cashed in. It's going to go eventually into cash, and we're going to be decreasing the investment. Now you might be thinking, okay, that's fairly straightforward. And it's not, once you get it down, you're like, that's not too bad. But there are some kind of quirks that could happen. You could say, well, what if the acquisition happened in the middle of the year? That can kind of complicate things a little bit. So if the investor may not accrue income earned by the investee before the date of acquisition. So in other words, if you say, okay, we bought the thing in the middle of the year, we put it on the books at the cost, and then you're thinking, well, now I got to think about the income that was earned. And if you're looking at the year-end earnings for this company, you can't record really the year-end earnings, because that would be recording income for the entire year, and you've only owned the stock for part of the year. So the amount of the income earned by the investee from the date of acquisition to the year-end may need to be estimated by the investor when recording the equity accrual adjusting entry. So in other words, you're like, okay, I purchased this thing, in the last quarter in October, and then I've only got 2 months really that I've had it on the books. I put it on the books at the cost, and now I'm looking at this in the income statement, which is typically yearly or quarterly for the company that I invested into. How am I going to fit? I mean, I can't record the income, adjustment for the entire year because I've only had it for like 2 months. And then, so there might be a situation where you have to basically do some type of adjustment, which might be just, a ratio or whatever. If it was a seasonal business, it might be a little bit more difficult, but some type of adjustment may be needed for that first year. And the second year, it should be all straightforward and not a problem. Okay, sale of shares. What happens when you sell a share that you're accounting for using the equity method? Investment account needs to be adjusted to the date of sale for the investor's share of the investee's earnings. So the first thing you need is basically, if you're selling the shares that you had at 20%, over 20% or significant influence in, then you need to make sure that you're recognizing the income up to the point of date of sale. So like if you're selling it on November 15th, ideally you would like to be able to recognize the income that the company that you have invested in, look at their income up to that point in time and record that income on the books, right? So now you have properly valued your investment as of the point in time of the sale. Again, that's not the easiest thing to do because the sale date could be in an odd, an odd period of time. But that's the idea here. And then a gain or loss is recognized for the difference between the proceeds received and the carrying amount of the shares sold. So that's going to be similar to just kind of a normal. Once you've done this step, then it's kind of like just a normal transaction. You've got these shares on the books now that have the value, and you're going to be comparing that to what you sell them for in a market type of transaction. Then, if only part of the investment is sold, the investor needs to decide whether to continue using the equity method or change to fair value. So in other words, what if you had something that you had significant influence over, presumably over 20% investment, you sold part of it, but not all of the stock, so you still have some stock of it left over. Then you got to say, all right, well now after that sale took place, does that take away my ability to have significant influence at this point? I mean, do I no longer at this time have significant influence? If so, then I need to basically think about whether I need to change my accounting method to stop using the equity method in that case. If I still have significant influence, then I can carry forward and use the equity method. So presumably then you would be saying, all right, did that take me under the 20%, which is usually the line to be presumed to have a significant influence over the company we are investing in.